wanted to take a look at XLE ETF. This is an ETF that follows the energy sector. It's a select stocks inside this ETF. Last year, January, I put out a lot of videos regarding going long XLE ETF because I felt the economy was going to continue to rally significantly. Obviously, that did. Then in November, I started saying, let's get out, let's get out. You can check my videos from previous. And XLE stock or ETF, XLE ETF did move lower. It's rallying again, and I'm getting ready to get back in and sell again. But there are some inverse ETFs you may want to take a look at, such as DUG ETF, which is the inverse for the select sector. There's also SCO ETF, which is an inverse to oil. Now, obviously, these energy sector stocks are driven by the price of oil. Higher prices, higher revenues, higher potential profits, but it's not a 1-for-1 ratio. There's a lot of math that no one has ever been able to figure out, no matter how many PhDs sit down and try and get a pen and pencil to it. Regardless, the economy itself will likely begin to shift, which could push XLE ETF back downward significantly. There has been a recent rally, and I think this is overdone. I'm looking at DUG ETF to buy on the dip, but also SCO ETF for those technical traders out there. This particular one, you could look at that and say, wow, that's a good strong buy on the dip opportunity. Given the economic data, given what the Federal Reserve is likely to do, we could see rallies in DUG ETF, SCO ETF, which means a sell-off in XLE ETF. Let's jump in. A lot to talk about. All right, welcome. If you've just started finding my channel here, I stick nearly 99% of the time to economics and how that applies to stock market, individual sectors, and individual stocks. I drive everything from the economy because the economy itself is what drives the stock market. If the economy is expanding, if the money supply is expanding, this of course expands revenues for companies, which would expand profits. So what drives that is really what I'm continuously looking at. Thanks for following along. This year I decided to, or not decided, but I finally got to a point where I could sit down and just start banging out all the content I wanted to because I took care of a lot of outside things that were just a major disruption. So you're going to see a lot more content regarding things like this. That was an introduction. There are 5 different things I talked about here. Go ahead and take a screenshot. Don't blame you. If you're new to this, XLE ETF, this is the Energy Sector ETF, one of. It's a major one of the biggest ones for the sector itself. I think it's like 45% of this is driven by 3 stocks. Your normal, usual suspects, and I have that in the next coming slide here. WTI, Western Texas Intermediate. That's another 3 letters that I threw out in that intro. Light Sweet, WTI. They kind of follow the same thing. Different types of oils. We are energy independent, except for the fact we are not. We have to swap oil. We can pull certain types of oil out of the ground, but it doesn't do everything we want to do. So we swap with other areas to get, say, gasoline, plastics, whatever it may be. And then other countries want our kind of oil. So you do have WTI and light sweet. They are different. And it's, I think, just the grading. I don't really look at the science behind that. Not really something I care much about, because all I care about is what are the prices. They tend to follow penny for penny, although they are not the exact same price. USO ETF is the oil fund ETF. This one follows the price of oil. Everything is sort of on a daily basis. If the price of oil moves up a certain amount, USO follows suit. I have charts showing you those. So if you think that oil is going to rally, but you don't have a commodity account, you don't want to fill out the forms or something like this, USO ETF is a good way to buy the dips should we see supplies dropping and oil prices moving higher. Geopolitics are always going to spike oil prices upward. DUG ETF, inverse ETF, negative 2x. So when we see movements in the energy sector itself, what these guys are trying to do on a daily basis is to move DUG ETF 2 times that amount. But it's an inverse. So if XLE ETF were to fall, say, 1%, the theory is you would get 2% on a rally with DUG ETF. SCO ETF, of course, is the inverse to oil itself. If you think WTI or USO is going to go down, you'd want to be taking a look at SCO ETF. Take a screenshot. Start looking at these. It's real easy to kind of get a grasp of what's going on. But the real question becomes, what's moving these? Because what moves these will move XLE. And because of that, this is sort of an economic thing. What are we looking at in the future from an economic standpoint? This morning we got PPI inflation data, came in, I think, 3.6% year over year. PPI, Producer Price Index. This is a good indicator of what consumers are going to have to pay a little later. It went down a smidge. I think it was 144.775 down to 144.675. This is basically flat for the month over month. The year over year was like 3.56%. So although one data point does tell us that, okay, maybe there's a top side to growth, the bigger picture is one data point is not an economy. Up until today, January 20th, we have a whole new economy should we get someone who just starts whipping a pen out. Tariffs, tax cuts, these are going to alter the landscape in which we're looking at. And from that, it's time to make money in the stock market. And so that's really what's kind of driving the economy. The economy itself right now is really strong. We're at 4.1% unemployment rate, just printed 256,000 new jobs. That's 256,000 individuals who are now in the economy capable of spending more. This after about a 248 upward revision for the month before. The economy is moving forward. Joe Biden is handing off a pretty strong economy, but inflation exists. The Federal Reserve has already signaled that they're likely to reduce the number of interest rate decreases for 2025 by at least 2. After Friday's print, a lot of major banks are saying, no, he's not just reducing that number by 2. He's going to 0 interest rates declines, may pivot and send interest rates higher because of inflation. But the big X factor / asterisk is Trump on January 20th. We don't know how he's going to alter things exogenous. So, breaking all this down, here is a look at XLE ETF itself, again driven by the price of Energy Sector. It is not a 1-for-1 ratio. The sector itself, 45%, of course, is roughly 45%, it might be 46, 47, are 3 stocks, and I have those listed below. In November, I think it was roughly the middle of the month, I said right around 92 to 94, you need to sell this thing. Went all the way down to about 82 half. Did move a little bit higher after my video. Timing hasn't always been my 100% forte. One of the reasons why I trade options. But as an options trader, I know a lot of you guys don't necessarily have that sophistication, have no idea puts, calls, put call ratios, the VIX and things like this. You're just like, dude, I just want to buy something that's going to go up. I get that, which is why I'm trying to bring in these inverse ETFs. Because on a daily basis, for you actual traders, looking at XLE ETF, should you say, listen, I think this is going to go down, but I don't have any way to get in there. These inverse ETFs are definitely the way to get in there. 2X. Keep that in mind for you traders who love juice. Okay, WTI crude oil. These two kind of go hand in hand. As the price of oil will rally, revenues for XLE ETF stocks, the companies inside there, their revenues would move up as well. Because whereas before they're pulling in X number of barrels, the price increases. So seeing WTI crude up to 77, 78, pushing up to 79, almost getting to 80, from 69, that's a pretty decent sized move. That's nearly 10% in a short period of time, just a few weeks. Just to kind of bring this in, WTI crude versus USO ETF. As you can see, they move hand in hand, although on a percentage basis, there is an outperformance. So if you do believe oil will rally, USO ETF is a great way to get involved in that. I don't know that we're necessarily at a price point right now where there would be a rally, but we do potentially have a lot of inflation coming. If Trump does well, first let's start here. We have inflation. The Federal Reserve is halting, at the least, may pivot because the economy is too strong. But then we have January 20th. Will Trump do his tariffs? This is inflation. These are taxes. You can defend him till the cows come home. My objective is make money in the stock market. I'm reality-based. Mr. Market does not care about your fictional beliefs. Mr. Market cares about reality. And I'm interested in making money in the market. And that's one of the reasons that continually drives me to look at everything. So given that, should Trump pull the trigger on his tariffs? This increases everything. Now, on the one hand, this is tax revenue to the government, which is good for the government. On the other hand, it is a zero-sum game. If you are taxing consumers, their consumption declines. Income is finite. So although there is a pull into the U.S. coffers, U.S. Treasury coffers, there is a reduction in consumption. We are a consumer-led economy. So if you reduce their capabilities, consumers' capabilities of pushing the economy forward, that means the economy moves, it contracts. It's a zero-sum game. So I get into arguments with individuals regarding, no, he's going to cut taxes and therefore the economy's going to rally. That's not what drives this economy. So while, yes, his tax cuts are probably going to be carried over, he will get that money, which would be inflationary if he just simply continued the tax cuts. The deficit would continue. And I think we're looking at about 4.5 trillion added to the deficit because of these tax cuts. Well, he's going to pull that money out of consumers. It's a zero-sum game. The economy will suffer. The economy will start to restrict, then contract. Given that, WTI oil, USO oil ETF, might be a little too high. We only have a few more days. What is today, the 14th? 6 more days, Monday. He swears in, and he says day one. That would be a really good day to go ahead and start realizing that these are probably about as high as it's going to get, given all the factors today. There could be something happening with oil production companies in countries where geopolitics spike this up. And then that would be a good time to get in on a short basis. Here's a quick look at the PPI number. Again, flat month over month on a year over year basis, pretty high. I'm not celebrating this, although I did clean out a few positions that I did have. Money supply. What really drives this economy? And this is one of the things that I keep diverting back to. The Federal Reserve has been reducing its balance sheet significantly. Who's been making up the difference? Banks. Commercial banks are lending money out, which is, as you can see, on a very rapid pace, increasing the money supply. So while the Federal Reserve had reduced its money supply two ways. Number one, increasing interest rates, number two, decreasing their balance sheet. Commercial banks are making up that difference much faster than the Federal Reserve is reducing its balance sheet. This is a big problem if you're trying to contain inflation. The Federal Reserve needs to get more aggressive, basically, because this number, which now is positive, is not going to hit the median and then just go flatline and we have a perfect economy. What will stop this? And what is really driving it? Businesses, which we're in a manufacturing boom right now, a lot of businesses are borrowing money right now and putting it to work, building and innovating into this economy. We lost a lot of manufacturing during COVID. We're getting it back right now. That there, for every action, there's an equal and opposite reaction. We're seeing price pressures. Businesses today believe that they can borrow money at these cheap rates and get profits that are more so it's beneficial to them. That's an inflationary red flag. The Federal Reserve is realizing that. How does, say, inflation and the money supply move? Kind of hand in hand, as these two charts will show. The red, of course, is money supply, the M2 money supply, total money in the system. The blue is the money supply. You can see that this is really kind of pushing things in a way that this could be a problem. All right, XLE ETF. Here are your top contenders. You really only need to look at the top three. And I took this out pretty early in the morning, but you can see there's some serious volume there. 22.2, 15.6, and 8.1 for the top three. Then we drop into the 4 and 3% on the weighting inside XLE ETF. So basically you're asking the question, Exxon, Chevron, and ConocoPhillips, ExxonMobil, of course, XOM, CVX, COP, the symbols for those three respectively, how are they going to perform? Oil prices are moving higher for now. The Federal Reserve is likely going to have to step in. Should Trump hit his tariffs, the Federal Reserve, at the very least, will not be lowering interest rates because immediately prices will start to move higher. It'll take 3 or 4 or 6 months till we see those prices move through the system, and then consumers start paying that price. So for now, we might have sort of a reprieve and big jumps in prices, but by the end of summer, we'll start seeing big increases in prices, and the Federal Reserve is likely to contain price pressures and push interest rates higher. At the same time, should the tax cuts be extended, that's a deficit. And in order to get institutions to invest, they have to lower prices, which would push up interest rates. Now, keep in mind one key factor, that the Federal Reserve invented money and bought debt. They're getting rid of that invention of money, if you will, very loosely. So another institution has to step in and buy that debt. By doing that, they're not buying another piece of debt. So it becomes inflationary. But there is new tax revenue in the form of the tariffs. Unfortunately, not a zero-sum game. Eventually, the economy will start to slow more and more and more. Plus, the Federal Reserve is going to be raising interest rates, which would slow growth more and more and more. That's a huge problem, which we come back to XLE ETF, USO ETF. They're a little too high. Here is a bigger look at, this is XLE ETF itself. Daily chart going back, this is the one-day bar chart going back to 2022. So you can see it's been moving up slightly, but let's take a look at how XLE ETF has performed versus SPY ETF, SPY stock, since just prior to COVID. And as you can see, there's been some solid rallying. The S&P 500, 114.5% at this time, whereas during that same period of time, 90% for energy sector stocks, XLE ETF. So it's comparable, but this is a commodity product, yet they're able to take a commodity and value add it. Being an oil company, all the little grocery stores at the gas pump, all the chemicals are producing, it's a value added. This isn't pure profit from just extraction of oil. There's a lot of companies in there. I think there's 32. So you can see that generally speaking, there is an in tandem look at this. The U.S. 10-year Treasury yield pushing 4.8%, bumped up against there today. For those of you who are interested, what I did this morning, I started posting some of on my Substack newsletter. You can subscribe to my Substack, or you can follow my Substack newsletter, dhtaylor.substack.com. Link is down below, plus it's on the end card here. I'm going to start putting my notes out there. These are entirely free. You can get alerts whenever I put a note out saying this is the trade I put on. And I did put on a trade this morning for TMF ETF, which is the 20 plus, I think it's 3x bond yield. I felt that today's number would, if you're looking at this 10-year, the 10-year, which the TMF trades off the 20 and the 30. But the 10 years sort of my go-to. This is the metric for the debt yields. You look at the 2-year, it might be a little lower. You look at the 30-year, it might be a little higher. 10's a good happy medium. And it's also the benchmark investment rate, period. So it was bumping up against 4.8%, and I thought, you know what, we're probably going to see some relief because today's number wouldn't really push someone to say, we need to get out right now and push the sell button, driving interest rates up much higher, despite the fact that we have CPI tomorrow. And I said this in my video yesterday, I don't believe CPI data is going to be eye-popping. What I believe CPI data tomorrow is going to be more like, steady as we go, and the way we're going, not exactly awesome. So I bought TMF, and it's a day trade. I'm trying to get out. I might actually be out, but I'm recording right now. I don't know what's going on. And I'm only looking for like 10 to 15 cents. Nothing. It's a day trade. But if you keep doing that every single day, after 250 days, that adds up. All right, DUG ETF. This is one, it's the inverse to XLE ETF. And I'm thinking that it might be getting close to time to pull the trigger. I'm looking around 34 to 35. If we see those kinds of numbers, DUG, the inverse, DUG ETF, the inverse to XLE ETF, it's not a 1-for-1 ratio, it's just a sort of, DUG ETF is the inverse to the energy sector itself. And what they hold in there is different than, say, XLE ETF. Nonetheless, I can see this one rallying at some point. This is something you want to do hit and quit. You don't want to buy into this and hold it for a long period of time, although that could probably work out just fine. I'm looking for moves a little bit lower to build up my confidence that this is a no-brainer. But we have inflation. What will Trump do? I have this massively, DUG ETF is massively on my radar. I'm looking to buy in on this. I may do some sort of very savvy XLE ETF options trading, but I keep looking at DUG ETF thinking that's interesting. SCO ETF, of course, is the crude oil inverse. So if you think oil is going to pause here, then flip, if you look around, I mean, this is a buy on the dip opportunity. What would push oil much higher? We have inflation. So that's not a guarantee. And what drives inflation is demand. We're in a pseudo-manufacturing boom right now here in the United States. We just printed 256,000 new jobs just last month. Unemployment rate declined. So is this a guarantee that SCO ETF, the inverse ETF for crude oil, will rally from this point? Now, I don't see it as a guarantee, not at all. I think we kind of see a bunch of stuff happening with more economic data showing that this economy is moving forward. But Trump could save the Federal Reserve's backside by pushing his tax cuts through, raising revenue via the tariffs, which would slow down the economy. The irony. Everybody's picking apart certain aspects of this, but as it turns out, the combination of the two, given the current economic environment, could provide the Federal Reserve the soft landing it wished it hit. Irony. Light Sweet Crude versus SCO ETF. I just want to throw this up there so you can see its relationship. It's an inverse ETF. Given all this, SCO ETF, DUG ETF, these two ETFs are highly on my radar right now. I'm looking to buy these because I believe they are oversold. That oil itself, WTI, USO oil ETF, is too high. But we still have a lot of inflation. Let's see what CPI does tomorrow. Let's see how Trump plays out in the next couple of 6 days. Monday. Will he do this on day one? Will we see those tax cuts? And how does that play out in the economy? What does the Federal Reserve do? I don't believe the Federal Reserve lowers any more interest rates. This economy is too strong. Economic data continues to show that this economy is too strong. And should we see a deterioration in the economy, too much supply is going to build up in oil, USO ETF would start to fall, which all of a sudden SCO ETF, the inverse to oil, will rally. Same with DUG ETF versus the energy sector itself. Make sure to follow along. Make sure to stop by my Substack newsletter and just follow or subscribe so you can get the alerts on my trades that I'm doing based on this kind of information. See you in the next video.